Business cash advances, pros and cons of using them for operational funding. When your small business needs fresh cash, a business credit card cash advance can prove vital. With a credit card cash advance, your company has immediate access to financing without wondering about how quickly you can get the money or the sometimes low approval odds you see in a traditional business loan application process. Check out this video to hear the pros and cons of a business cash advance. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Let's roll. Today I want to talk to you about business cash advances, the pros and the cons of using them for operational funding. Now, before we get into the nitty-gritty, let's go to the definition here. What is a business credit card cash advance? A cash advance from your business credit card generally allows you to immediately get cash by drawing from your credit card's line of credit. So to get a cash advance, you will need a credit card that has available credit. So for example, if your credit card has a $10,000 balance, you need to have the $10,000 is untapped. That means you can, if the credit card company so allows, you can tap into the 10 grand and you can withdraw it. Some issuers may restrict the amount of your available credit that you can use for cash, right? So for instance, you can have a 100,000 balance and only 50,000 of that amount is available for cash withdrawals. So you can check your available credit on your online account or by calling your issuer. Now, you can get a cash advance in one of two ways. You can go to a physical ATM and withdraw the money, or you can go to a local bank or credit union branch where you will present your card and an employee will process the advance. So you can visit any ATM or a financial institution that accepts the brand of card you carry, such as MasterCard or Visa or Discover or American Express. It doesn't have to be the financial institution where you have an account. Now, if you want to deposit those funds into your business bank account, you may want to get the advance from your financial institution. So you'll have to provide satisfactory identification such as driver's license so they can give you the money. In some cases, your issuer might allow you can actually get a business credit card cash advance by actually doing a wire transfer. So the issuer will give you an account. They will give you an account, a bank account that you have to give to the institution doing the transfer, and you basically do the transfer online. So when the debit information is presented to your issuer, they will accept it. Now, in the case of a cash advance from an ATM, remember that you always need to have a PIN number. You need a PIN. So if you haven't already been assigned one or lost yours, you want to contact right now your card issuer, or you want to go into the financial institution. You can want to go physically and request that PIN. Now that we have defined what a business credit card cash advance is, let's talk about how much it costs. Most credit card issuers charge a different interest rate for cash advances than for purchases, right? So the APR for your regular purchases could be, say, 10%, and the APR for cash advances is 20% or 23%. So the cash advance rate is often higher than the purchase rate. And it usually, as I said, hovers around 20 to 25 if you have a good credit score. If not, it might go all the way to 30%. Also, many issuers charge a cash advance fee of 4 to 5% of the advance, often with a minimum fee of $10. So that fee is added to your balance as soon as the advance is processed. So if you access a cash advance from an ATM, you may even incur an additional ATM fee. So you got to think about all the costs before opting for a credit card cash advance. So with a cash advance, you lose the benefit of the grace period, and interest is charged immediately on the balance. So the combination of the higher interest rate and fees, can make this an expensive way to borrow for your business. Right now, at the same time, it may be cheaper than other types of fast financing, which can charge interest rates of 30 to 90% APR or even more. So you got to think about what works for you, why you need the money, how fast you need the money, and your funding options, the funding options you have available for your small business out there. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Cuba. We are still having a conversation around business credit card cash advances, the pros and cons of using them for operational funding. Now, let's talk about the potential pitfalls. Now, I spoke earlier before, I spoke about the cost. You have other drawbacks when using a business credit card cash advance. The thing here is that another con here, if you will, the other pitfall is that you may not be able to pay back the debt. If you default on a credit card, your personal and business credit reports and scores are likely to be adversely impacted. Small business credit cards from major credit card issuers require personal guarantees. In other words, if your business cannot pay back the debt, you will be personally responsible. Remember that as your balance increases on your credit card, your monthly payment will rise. So you want to carefully and thoroughly consider whether you can make the higher payments, right? So it's all about balancing. You have to strike the right balance between your operational needs and the financial consequences. Now, minimum payments are often so small that if you only pay the minimum, your business will be in debt for years or even decades. So you need to calculate. You can even sit with your accountant here and calculate how long it will take you to pay off your debt. Because of the cost, these cards are best if you use them for short-term financing. And granted, even if you pay on time, the balance may affect your credits, not only your personal credit, but also your business credit. Some small business credit cards report activity to the owner's personal credit reports. So if you have a high balance in comparison to the credit limits, it can lower your credit scores. Again, here, two credit scores: business credit scores and personal credit scores. Some business credit scores also evaluate debt usage, right? This is basically, again, debt usage means you take the available balance divided by, you take the used balance, you divide that by the available balance. So for example, you would have a 40% debt usage if you have access to, let's say, 100,000 worth of limit, and you have tapped 40,000 out of that 100,000. So 40 divided by 100, that's 40%. Right now, debt usage does not tend to have as significant impact as it does with personal credit scores. Now, when you default on your business credit cards, you need to understand that you have a series of actions, a series of negative elements here. Number one, late fees and interest accumulates. So when you stop paying your credit card bills, automatically you have late fees that are added to your credit card accounts. In addition, your minimum monthly payments increases because you have to make up the payments you've missed and pay the late fees. Even damaging, your interest rate will increase to the higher penalty rate after your account becomes 60 days past due, which is 2 missed payments. And of course, each month your minimum payment will get larger as more late payment fees are added to your balance. So one thing here is that when the penalty rate kicks in, your finance charges will also increase, which adds more strain onto your company's balance sheet. Consequently, your outstanding balance and the payments you need to catch up on gets larger every month you are late. So it becomes increasingly difficult to catch up the more behind you are. Besides the late fees and interest, you have a lasting effect, because even if you catch up, the penalty rate will remain in effect until you made 6 consecutive payments on time. And after that, the interest rate must go down for your existing balance, but the penalty rate can remain in effect for new purchases. You also have other pitfalls. Collection efforts increase, right? So your credit card company, the issuer, their billing department will begin to contact you by phone, mail, text message, or email to remind you of your credit card payments. Now, unfortunately, you can't stop calls from your credit card companies the way you can with a debt collector. So if you want to stop debt collection calls, the Fair Debt Collection Practices Act allows you to send a written cease and desist letter telling the issuer you don't want to be contacted anymore. However, the same law does not apply to your original creditor. So you can send that letter rather to the collection agency, but not to the original creditor. So you cannot send that letter to the issuer, but you can send it to the debt collector. Now, if you are only a few days or weeks behind on your payments, calls from your creditor aren't frequent. So in this instance, what they do is they will gently remind you to become current on your account. Nonetheless, the further behind you get, the more frequently you'll be contacted. Not only that, the payment reminders get harsher in tone and start mentioning serious action like charge-off and default. So your creditor may eventually send you a settlement offer, which generally will let you know that you are off the hook for the debt if you pay a percentage of your outstanding balance in a lump sum payment, which again, this is not the kind of course of action you want to take because of the next thing that happened. Your credit report and credit score are negatively impacted because late payments are generally added to your credit report as you become 30, 60, 90, 120, and 180 days late. Unfortunately for you and your small business, these late payments will make your credit score decrease significantly and could ruin your ability to get a new credit card or future loan, right? Because everything is linked here. When we talk about credit, whether it is personal or small business or business related, everything is linked. So your insurance rate, for that matter, could also increase as a result of credit card delinquencies. So 6 months or 180 days after you stop making your credit card payments, your account will be charged off. If that were to happen, the credit card company writes off your unpaid debt as a business loss. So while you no longer owe the money, you get a serious blemish on your credit report that will stay there for the next, and check this out, 7 years, alerting everyone that you once defaulted on a credit obligation. Now, the fact that the credit card company has charged off the account doesn't mean you don't owe them the money anymore, because your account may go to a collection agency. So charge-off accounts are usually sent to a collection agency. From there, they are moved from one collection agency to another until they're paid or discharged in bankruptcy. So your original creditor or a third-party debt collector can sue you for the debt until it's paid or settled in bankruptcy. So don't think that because the company, the issuer has charged off the amount and it's no longer, they have charged it off as a business loss, that doesn't mean that you are off the hook. They will still pursue that debt, because after a certain amount of time, the statute of limitation can protect you from a lawsuit judgment, but the account must be completely inactive for several years, and the burden of proof will be on you. The courts have been very methodical in applying that burden of proof, I would say dogma or burden of proof restrictions. So the burden of proof will be on you. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of A Sweetie Kiwi. And we are having a conversation today around business credit card cash advances. And I've talked to you about the pros and cons of using them for operational funding. Now, there are alternative options for financing your small business. And even though we are talking about credit card business credit card cash advances, in case you don't have a credit card or your limit is high, your debt usage is 90%, so you have no more money on the card, you have to repay, or you want to explore other alternative financing option, let's dig a little further here, because other options you may want to consider for fast access to funding may include an overdraft line of credit on your business checking account, an online small business loan or line of credit. You also have another way to access cash from your business credit card, and that's called a balance transfer, right? Many issuers will allow you to get a balance transfer at a lower interest rate than at a cash advance. For example, they might say, we're granting you rather 0% interest rate for 12 months plus a fee of 3 to 4% of the amount of the advance. So issuers may allow you to deposit this funds into your bank account. However, it can take up to 2 weeks to process a transfer, so it wouldn't be as fast as a cash advance. Now let's dig a little further here into the pros and cons of a balance transfer, because obviously balance transfers, when the rates are low, are beneficial to you. They're better than a business credit card cash advance, although as I said earlier, they might take more time. So what are the pros of a balance transfer? You can take advantage of a lower credit card interest rate. This is especially advantageous to you if you currently have a higher interest rate on the credit card balance you are considering moving. So if you transfer a balance to a credit card with a lower interest rate, you have a chance to make a bigger dent in your credit card balance, right? Because you'll have obviously a lower interest rate and possibly no financing charges. So more of your monthly payments will go toward reducing your credit card balance instead of towards interest. You may even be, if you're lucky, you may even be able to pay off your balance completely by the time the promotional period ends. The second pro is that the second advantage of a balance transfer is you can move your balance to a credit card with better terms, right? If your current credit card has bad terms, for instance, a short grace period or higher fees, you can move your balance to a better credit card and close out your old credit card account for good. The new credit card may even offer credit card rewards on your new purchases. We had an entire show on the small business credit card. You might want to check that show. We talked about a whole array, a whole constellation of credit cards, from those with rewards, with perks, with mileage, whatever. You just check it out. The third advantage of a balance transfer is that you can consolidate your credit card debt. Right? By doing that, you leave yourself with fewer credit card payments to make each month. So if you move multiple credit card balances to a single credit card, given it has a high enough credit limits, this can eliminate the hassle of making multiple credit card payments to several different credit cards. So having a single credit card to talk to, every credit card bill to make every month, it's a lot easier, right? It becomes easier to pay off one credit card balance than it is to pay off several. So that's for the pros of a balance transfer. Let's talk about the cons, the drawbacks of a balance transfer. Now, you got to look at the downside, and because there is a downside of transferring a balance to a new credit card, even with a balance transfer offer. You could end up with a higher interest rate. That's the first disadvantage. If you don't qualify for a promotional interest rate, you might end up with a higher interest rate, because not everyone qualifies for the promotional interest rate. You generally must have an excellent credit score to get a low interest rate balance transfer offer. Otherwise, you'll only qualify for the regular, which is often higher, balance transfer interest rate. Next, balance transfer can get expensive. So considering the balance transfer fee and the annual fee if the new credit card has one, before you transfer your balance, make sure you take into account the full cost of moving your balance, and you want to compare that to the interest you would pay if you left your balance on your old credit cards. Leaving your balance on the old credit card may cost less in the long run. Another disadvantage here is that a balance transfer could hurt your credit score. Think about it, because applying for and opening a new credit card account can affect your credit score, whether it is personal or business. Not only that, your credit score takes a hit anytime you have a credit card with a balance that's above 30% of the credit limits. That's the debt usage I was talking about earlier. So if you move your credit card balance to a credit card that doesn't have enough available credit, your credit score could drop. Now, having said that, the good news is that you can recover lost point by reducing your balance with timely credit card payments each month. The next drawback of a balance transfer is that you are at risk of more debts. If your whole idea was to consolidate the debt, it is okay, but you are at risk of more debt. Once you transfer your balance to a new credit card, you suddenly have more credit available to you, right? So unless you are disciplined, unless you are methodical enough not to make purchases on your old credit card, you are fine. Otherwise, you'll end up with more debt than you started with. So you want to close your old credit card if you need to remove the temptation to rack up more credit card debts. Now, when to consider a business card cash advance? There are times when this financing option makes sense. I'm talking here about the business credit card advance. Even though there are consequences, there are negative effects, there are moments when, especially if a balance transfer offer is not available to you, you gotta go and just use the business card cash advance. So let's say you need cash quickly for a short-term need, and less expensive sources of financing aren't available, including a balance transfer offer. If that's not available and you need the cash, you can consider a business card cash advance. Another option is if you have a critical need for short-term financing and will have trouble qualifying for other financing options, it might make sense, depending upon your company situation, to tap into the cash on your business credit card. All right. This is it, folks, for today's conversation. I really appreciate it. Today, I was talking to you about the business credit card cash advances, the pros and cons of using them for operational funding. I spoke about business cash advances, the pros and cons. I spoke about what is a business credit card cash advance, how much it costs, the potential pitfalls, and when you default on your business credit card, what are the consequences? I talked about late fees and interest accumulation, a lasting effect on your credit score, collection efforts that increase, your credit report and credit score are negatively impacted, and your account may go to a collection agency. I spoke about the alternative options of a balance transfer, and I gave you the pros and cons of that option also. And finally, I gave you some insight as to when you should consider a business card cash advance. I will talk to you another time, but until then, remember, stay marvelous.